Hello, everyone. Welcome to Kudlow. I'm Larry Kudlow. Today, big, very big inflation report. It's all the news and all the rage. Here comes inflation, 0.6% in May, 8.4% at an annual rate over the past 3 months, 6.5% at an annual rate for the first 5 months of this year. The Fed's target used to be 2, which is what we had for over 20 years. So all these recent numbers sound pretty bad and pretty ominous. So let's talk about this. That's what we have to talk about tonight. Question, is Jimmy Carter back? But wait a minute, some conservatives are not going to like me for this, but actually, really, truthfully, Jimmy Carter did not launch the double-digit inflation of the 1970s. He was captured by it. I don't think he ever really understood it. It wasn't just about oil prices, but he did appoint Paul Volcker to run the Fed. Volcker, my former boss at the New York Fed. I was Volcker's executive assistant 46 years ago with the New York Fed. Anyway, under Ronald Reagan, it was Volcker who slayed inflation. Reagan gave Volcker the ground to stand on. But frankly, honestly and factually and analytically, the American president who unleashed double-digit inflation was Richard M. Nixon. That's right, it was. Unfortunately for President Nixon, he closed the gold window where the dollar exchange rate was $35 an ounce. That went back 26 years to the post-World War II deal reached at Bretton Woods in the famous conference in New Hampshire. That's what restored the gold exchange standard after the war economy. The dollar was at the center of that system. Mr. Nixon, unfortunately, destroyed the system. He worried about trade deficits and deteriorating balance of payments, and he rejected the advice of then Treasury Undersecretary Paul Volcker and then Federal Reserve Chair Arthur Burns. They said, don't do it, but Nixon closed the gold window, meaning no more exchanges of dollars for gold. So the value of the greenback fell like a stone, fell like a large stone, dropping endlessly down a huge shaft. So as the value of our currency declined, prices, of course, denominated in dollars, skyrocket. We printed bad money. We printed too much of it. And that really is the definition of inflation. Excess money in relation to its demand. It'll do it every time. Lack of value is what causes inflation. By the way, Mr. Nixon also imposed an import surtax on all goods and services coming into the United States. In effect, it was a big tax hike, all right, protectionism. Now, in 1973, Nixon abolished all remaining remnants of the gold-dollar exchange system, and inflation continued to roar. That's when it first hit double digits while Mr. Nixon was president. All commodity prices skyrocketed, including oil, everything else. On top of that, income tax rates were not indexed to inflation in those days. So higher and higher inflation drove middle-class working folks into higher and higher income tax rate brackets, which had a huge braking effect on the entire economy. In other words, stagflation. And intermittently, from then until Reagan, inflation would pop up to double digits. Interest rates wound up about 15% at the peak in the government bond market. The prime rate peaked around, I think, 21.5%. Finally, when President Reagan came in, he squelched it all. Reagan was a hard money gold advocate. He was a friend of Milton Friedman. And my former boss, Mr. Reagan, gave Volcker carte blanche to restore dollar value and vanquish inflation. He said, just do what it takes. And then, of course, the Gipper slashed tax rates from 70% to 28%, providing fresh after-tax incentives to rejuvenate the entire economy and give folks back a lot of their lost real income from the Nixon-Carter hyperinflation years. And really, since the early 1980s, the U.S. hadn't had any inflation. It's averaged about 2% per year for almost 30 years. Now, one more point about inflation. Inflation is everywhere and always a monetary phenomenon, as Milton Friedman taught us, and as Presidential Medal of Freedom designee Art Laffer and Nobel Prize winner Robert Mundell taught us. The optimal policy mix is stable money and low tax rates. Stable money keeps prices stable, and lower tax rates strongly push the economy forward through the incentive model of growth. Now, years ago, I coined the phrase king dollar, and actually it stuck down through the years, but all I was doing was referring to the stable money component of the Laffer-Mundell policy mix. And of course, the Laffer curve, lower tax rates produces more tax revenues at faster growth rates. That prevailed during the JFK years and the Reagan decades, and most recently, my other boss, former President Donald Trump, was a devotee of the Laffer curve. So, against that background, I don't think today, now, is the 1970s. I just don't. Actually, despite the recent jump in inflation, the dollar has held its ground reasonably well. Financial market price signals like 5- and 10-year Treasury break-evens in the TIPS market have increased a bit, but not much. I mean, they've edged up towards 2.5%, but not much, and certainly have not reflected this 6 to 8% inflation we've had year to date. On the gold story, gold hasn't moved much, but it is today up about $1. But gold was below $1,700 at the end of March. And today it's closing in on $1,900. So that's not a great signal. So it's a mixed bag, okay? The Treasury break-evens are saying they're not worried about long-term inflation, and they're seeing through it. The gold price, menza. Commodity prices are way up. I don't know if we have our CRB spot commodity chart handy. We tried that one last night. Didn't work out that well. So we either don't, maybe we'll get it later as we have a conversation. The floor manager's signaling no, so I'll stop on that. No CRB stuff, maybe sometime in the future. Anyway, a couple last thoughts. First, if Uncle Joe Biden gets his green worker paradise, Soviet-style Bulgarian economic policies, massive tax increases, massive social spending, destroying the fossil fuel energy sector, then the dollar will collapse and leaping tax rates will choke off economic growth. Call it the 1970s with a socialist spin. In that case, we will have permanently higher inflation, and we will have weaker and weaker economy. Now, if on the other hand, Mr. Biden's green worker paradise does not get voted in, then I'm going to say this inflation bump is just going to be temporary, all right? A couple more months, that's all. Really a rebound from the pandemic deflation. And actually, it's a sign of strong economic growth. There'll be no long-term inflation consequences. That's if we don't get the Bulgarian model. See, right now, we're still operating under Trump rules, right? Tax cuts, minimal regulation, energy independence. Hence, the vaccinated V-shaped recovery. And Keynesians notwithstanding, growth does not cause higher inflation. More people working is a good thing. Lower unemployment is a good thing. Prosperity should be a great American goal, not the 1.8% economic baseline that Team Biden published as a pathetic defense of their left-wing redistributionist policies. So, kids, I'm just going to say, we'll see about this inflation story. We'll see. We're watching it closely. Right now, since I don't think we're going to get the Bulgarian Biden model, I'm not worried about inflation, and I think the outlook for Trumpian growth is good. But if I'm wrong, and we get Uncle Joe's model, then we will have lots more inflation and lots more other problems regarding impoverishment and more people not working and all the rest of it. So which do you choose? Very interesting. That's our topic for tonight. Joining us now to discuss